have reduced your positions in China dramatically.
What we have done is we have consolidated our positions in China.
Isn't it wondering how China has established itself into an economic power within 20 years? This fast pace of economic development has not ever been witnessed by any country in recent times. However, what if we tell you that this economic gain of China is nothing more than a bubble that is about to burst? According to Cathie Wood, CEO of ARKK Invest, this will happen with the Chinese economy soon. She recently came with an interesting update in which she compared the Chinese current situation to that of Japan in the 1990s, triggered by a huge housing market bubble. Likewise, China is currently facing what we can easily term as the biggest housing bubble in history. Is this housing bubble the beginning of a more significant downturn? What does Cathie Wood foresee for China's economic future? Let's get into details of Cathie Woods and her take on Chinese economic turmoil.
We have evolved towards those companies that are serving more and more of the population. Regulatory clarity, taking away uncertainty, is a positive for investors.
First, getting to know Cathie Wood. Cathie Wood was once a standout investor, largely due to the strong performance of ARKK Innovation ETF in 2020 and 2021. It was an exciting time for her fund. However, after February 2021, things went downhill fast, and her company's performance took a severe hit. This sharp decline has earned her a place among the top 3 wealth destroyers from 2014 to 2023. During this period, her company lost around $7.1 billion in shareholder value. While some admire her bold investments in future technologies, others see her as a marketer who makes risky bets with clients' money and profits no matter the outcome. Before discussing her views on China's economy, it's essential to note her long history in finance. Wood started as an assistant economist at Capital Group for 3 years before moving to New York, where she held various roles, including chief economist, analyst, portfolio manager, and managing director at Jennison Associates for 18 years. In 1998, she co-founded the hedge fund Tupelo Capital Management, and by 2001, she joined AllianceBernstein as Chief Investment Officer of Global Thematic Strategies, managing a $5 billion portfolio. Despite her experience, she struggled during the global financial crisis, which cast doubt on her strategies. Her career shows her deep knowledge, but her results remain divisive. The ARKK Innovation Fund. After leaving AllianceBernstein, Wood started ARKK Invest in 2014. Her idea to actively manage ETFs focused on disruptive innovation was considered too risky by her previous employer. Interestingly, Bill Huang of Archegos Capital provided the initial funding for her first 4 ETFs. Huang was later found guilty of fraud and market manipulation after his fund collapsed, leading to massive losses for major banks. While there's no evidence Wood was involved beyond the initial funding, the connection is notable. Wood's ARKK Innovation Fund invests in companies focused on disruptive innovation, defined as new technologies or services that could change how the world operates. This includes areas like autonomous transport, neural networks, cloud computing, and cryptocurrency. The fund features companies like Tesla, Roku, Coinbase, Roblox, Block, CRISPR Therapeutics, and Robinhood, though many are still unproven, with the top 5 stocks making up nearly 43% of its assets, making it a high-risk, high-reward venture.
When any country undergoes a period of change because of policymaking, we need to understand what the change means. And in the case of China, what we have done is we have consolidated our positions in China towards those companies that we believe are more focused on common prosperity. And so for right now, that means there will be changes in management, and we also need to know how the margin structure, so the gross margins and the operating margins of the companies are going to change, because common prosperity means probably lower prices and lower margins to benefit the population.
Why is there such extensive coverage of this particular fund? And why does Cathie Wood receive both praise and criticism? The answer, as expected, lies in the fund's performance over time. If we look back to 2020, media coverage was overwhelmingly positive for both Cathie and ARKK Invest. They were hailed as visionaries, as their bold predictions were turning into huge gains. After hitting lows of around $37, the ARKK Innovation Fund surged over 300% within a year, an incredible rise. Cathie Wood was quickly being compared to Warren Buffett, and the media couldn't get enough of her. Headlines like, Cathie Woods ARKK Innovation becomes largest actively managed ETF after 170% return in 2020, and Cathie Wood takes the crown from JP Morgan for largest active ETF, dominated financial news. Forbes highlighted her as one of America's richest self-made women, while Bloomberg praised her insights. Cathie and ARKK were everywhere. A major driver behind the fund's stellar 2020 performance was Tesla, which saw an astonishing 1,300% rise, fueled by a wave of speculative buying. With Tesla making up roughly 10% of ARKK Innovation's holdings at the time, Cathie's bet on the company seemed nothing short of brilliant. Her bold price targets for Tesla only added to the perception that she had exceptional foresight. That was the appeal of Cathie Wood, her ability to make bold, bullish predictions, setting enormous price targets and doubling down on companies she believed in. At the time, these moves were proving successful, and her confidence in her strategy was evident. Week after week, she appeared on various programs, defending her approach with such conviction that it became easy for investors to jump on the ARKK Invest bandwagon. This attention was exactly what ARKK Invest wanted. The firm generates revenue by charging fees on its investment products. The more people who believe in her vision and invest in her funds, the more profit ARKK makes. However, the cost of these funds is significant. ARKK's flagship product, the ARKK Innovation Fund, carries an annual fee of 0.75%. To put that into perspective, for every $100,000 invested in the fund, $750 is collected in fees annually. This stands in stark contrast to SPDR S&P 500 ETF Trust, SPY, the world's largest S&P 500 index fund, which has a much lower fee of 0.0945%. For the same $100,000 investment in SPY, only $94,050 would be charged in fees each year, almost 8 times less than what ARKK charges. This difference highlights just how much more expensive Cathie Wood's funds are compared to traditional index funds, making them a far pricier option for investors. The marketing engine behind ARKK Invest is undeniably powerful, and in 2020, it seemed to work flawlessly. The bold predictions, podcast appearances, and frequent features on CNBC paid off handsomely as the stocks in Cathie Wood's portfolio surged. During that time, she reigned as the queen of investing, with everything seemingly going in her favor. This led to a massive influx of capital into her funds, propelling her net worth to new heights. In fact, as noted by Morningstar, ARKK Invest ETFs had assets of just $3 billion at the start of 2020, but by year's end, that number had ballooned to over $34 billion, thanks to both strong inflows and stellar performance. It was an impressive rise. The failure. However, as with every boom, there comes a bust. For Cathie Wood, the party came to a halt in February 2021. As the year dragged on, investors grew increasingly frustrated by the fund's poor performance. Then, in 2022, when the Federal Reserve tightened economic conditions with rising interest rates, things went from bad to worse. From its peak in February 2021 to the close of 2022, the ARKK Innovation ETF suffered a staggering 80% decline. The businesses in its portfolio struggled under the weight of tougher market conditions. Tesla dropped sharply throughout 2022. Roku lost much of its value. Coinbase plummeted as the crypto market collapsed. Roblox suffered significantly. Block took a nosedive, and CRISPR Therapeutics was severely hit. Nearly all of Cathie's major stock picks were crushed, creating a brutal experience for ARKK shareholders. Unsurprisingly, the media narrative shifted. Cathie went from being hailed as a stock-picking genius to being labeled a speculator and a gambler. One of the most damaging blows came from a Morningstar article, which analyzed the top 15 wealth-destroying funds over the past decade. It found that ARKK's Genomic Revolution ETF had cost investors about $4.2 billion during that time. Worse yet, the ARKK Innovation Fund was responsible for losses exceeding $7 billion. Shockingly, the ARKK Innovation ETF ranked as the third largest wealth destroyer in that period, surpassed only by leveraged ETF products. So, what's the final verdict? Is Cathie Wood a misunderstood visionary or something closer to a fraud? To be clear, it wouldn't be accurate to label her a scammer. Her ETFs are actively managed investment products that investors can choose to buy or not. However, calling her approach investing in the traditional sense may be a stretch. A Reddit post titled, "Is Cathie Wood's trading strategy a form of value investing?" sums it up well, with the top reply stating, "LOL no, she's a speculative investor focused on tech hype and Bitcoin." Many agree that she is too heavily invested in unprofitable companies and apply overly optimistic assumptions. One commenter even described her approach as a mix of speculation and promotion, which seems to capture the sentiment around her strategy. Cathie Wood's relentless focus on emerging technologies may yield significant returns in favorable market conditions, as it did in 2020. However, by structuring her fund this way, she violates Benjamin Graham's foundational investment principle, the safety of principal. Graham, in his book Security Analysis, defined an investment as one which, upon thorough analysis, promises safety of principal and a satisfactory return. Wood's strategy appears to prioritize high potential returns while neglecting the protection of investor capital. In comparison, Berkshire Hathaway, though it may not deliver 200% gains in a single year, follows Warren Buffett's philosophy of safeguarding capital first, then pursuing satisfactory returns. ARKK, on the other hand, shows little effort to protect capital, as evidenced by the companies it holds. A look at ARKK's top 10 holdings for the year ending in December 2023 reveals that only 2, Tesla and Palantir, were profitable. The other 8 businesses remained unprofitable. The truth is, portfolios like ARKK's thrive only in speculative markets with low interest rates. These companies burn through cash and rely on easy borrowing conditions or speculative buying frenzies to stay afloat. When interest rates rise and markets tighten, these stocks tend to crumble. And that's precisely what has happened. Now is the time to look for her opinion on the Chinese economy and why it holds value. So you see, Cathie Wood's opinions on the Chinese economy hold weight largely due to her track record of making bold and forward-thinking predictions in the tech and innovation sectors. While her approach to investing has garnered both admiration and skepticism, her deep understanding of global markets, particularly in disruptive technologies, makes her insights valuable. However, her predictions about China's economy should be approached with caution. Wood tends to focus on high-growth opportunities, often in risky and speculative areas, which means her outlook may lean toward the optimistic, much like her strategies with tech stocks. The Chinese economy is complex and subject to unique political and regulatory challenges, which makes forecasting more uncertain. Whether Cathie's predictions about China will prove accurate is difficult to say, but given her history, it's clear that her opinions should be considered as one of many viewpoints, not necessarily as the definitive guide. Chinese real estate bubble. Coming back to the Chinese economy, it has seen remarkable expansion over the past 2 decades. A major chunk of this growth can be attributed to the once booming real estate market of China. That is how a significant portion of the country's GDP growth was based on property developers who took out generous amounts of credit to expand their real estate portfolio. These developers have been putting up apartments, office spaces and houses all around the various cities of China. Now well established to cater for the increasing housing needs, this industry has, however, grown to have some major issues. Soon, agents and speculators discovered the possibility of making quick money on estate business, since the prices of houses could only be upwards. Real estate being one of the most sought-after investment opportunities among Chinese citizens, the prices extended to infinity for most people. This made the increasing prices to give an indication that investing in properties is a sure way of increasing one's wealth. First, the intrinsic demand for residential premises was stimulated by the growth of the population of China. However, the extrinsic factors have enhanced the speculative factor to a much higher magnitude. This came out clearly when home prices in the key cities such as Beijing and Shanghai reached levels that were unattainable by the ordinary Chinese citizen. Many were forced to focus on the outskirts of these cities in search of relatively affordable housing, and while not being too far away from their jobs or other city amenities. This shift in demand resulted in most of the property buying taking place between 10 to 15 miles from the city centers. But when more people started shifting to the outskirts, the prices in the areas around these outskirts began to escalate too. As a result of increased market demand, property developers were more often than not able to predict the future requirement for suburban homes. They continued to build more houses for people in other areas, which they thought people would continue to expand toward. Thus, the extent of the land that has been turned into a modern neighborhood with its tall apartment buildings can be as far as 2 hours from Beijing and 2 hours from Shanghai. Yet, there's a strange twist to this narrative. More often, these structures are never occupied. These areas have been named the ghost cities because despite being constructed and nicely planned, they are empty of people, the most vital factor. Among the most well-known ghost cities, one cannot fail to mention Ordo's new town. Constructed to accommodate a population of 1 million people, the city failed to reach the goals, and by the year 2016, the number of people occupying the city were 100,000 only. Reducing expected inhabitants by this much shows increasing trends in what has already become a mystery in China's real estate market. It's even reported how in efforts to occupy the emptied homes, authorities moved the best schools in the region to the area, and this only helped in some way. More shocking is the fact that the extent of idle housing in these ghost cities is enormous and could easily house Italy's population. Today, the market value of the Chinese real estate market stands at over 60 trillion after 2 decades of its price hike. To put that into perspective, this is slightly over twice the worth of the US real estate market and 3.5 times the size of China's total gross domestic product. An investment firm, Loomis Sales & Company, has priced China's property assets at 30 trillion, almost double of its GDP, and said that 70% of this total is now invested in property. Today, you have to work for 20 years, save for 20 years, just to be able to buy one property. Despite this, however, many are still unable to afford homes without having to take large mortgages, where the prices of properties, particularly suburban ones, are still too expensive in relation to income per head. The overall demands to invest in property are made to remain constant by the ongoing anticipation that price levels will keep on rising, making the prospective owners develop a feeling that they need to acquire the property immediately in order to avoid being locked out. As a consequence, people are getting into a very risky level of borrowing in order to purchase homes that are unreasonably expensive to pay for. Moreover, it is frightening to note that 4 of the 10 most expensive cities to live in globally are in China. Due to the high increases in housing prices, this prompts a question of how sustainable this is in the current economic climate. The bubble that has been created in China's real estate sector is likely to burst at some point, and when it does, the impacts can be grave. This scenario raises questions similar to those associated with the ideas of Cathie Wood. In contrast to traditional real estate sectors, Wood supports innovative industries and markets, including technology and renewable energy. Her investment views that stress on long-term value sustainably created by innovation are strikingly different from China, where property speculation is the mainstay of the economic model. Wood's approach might make her be skeptical of the huge Chinese real estate bubble, that such growth in one sector may pose a big threat. Although property development has been one of China's significant sources of economic growth, Wood may argue that real value creation occurs in industries that have the potential to redefine and reinvent the existing markets, rather than the ones which depend on acquisitions and increasing prices of assets.
I think regulatory clarity, taking away uncertainty, is a positive for investors. Now, in the beginning, it's a shock. And that's why we reduced our position saying, okay, who are the new leaders of these companies? What will the margin structure, so the profitability of these companies be? And then once we figure that out, given how amazing the opportunities are in China, given the entrepreneurial spirit, the DNA of China, the entrepreneurial spirit is such that once these entrepreneurs figure out, okay, what are the new rules of the game, they'll figure out how to thrive in the game. So it doesn't mean we're negative long term.
History, repeating itself elsewhere. It was the same picture in America in 2008, and now we see the same picture in China. The Chinese property market is still on an upward growth trajectory, although signs of a marked deceleration are now evident. As property prices in China have remained on an upward trend, consistently hitting new heights, developers have been eager to increase their portfolios as fast as they can, with little care for the consequences. Before any financial disaster, greed creeps in, and what we find is that developers borrowed and got deeper in debt, which has now become the norm. One of the best examples illustrating the issue is Evergrande, which is one of the Chinese real estate development giants. Evergrande is one of the leading property developers globally, and while it grew exceptionally fast, it mostly did so with money borrowed through corporate bonds from global investors. Obtaining funding of over $300 billion in debt, the company increased the size of its developmental profile to more than 565 million square meters of land. This large amount of cash enabled the company to grow rapidly, and in 2018, Evergrande became the largest real estate developer in the world. But this success was short-lived. With the onset of the company's decline, it became evident that it had gone way over its head. More recently, the firm missed an interest payment of $260 million, and credit rating agencies declared it in default. It has been seen that there has been a heavy crash on Evergrande's bond prices in the recent months. Bondholders, most of whom are from foreign countries, were left counting their losses and have since proceeded to court to administration in a bid to reclaim their money.
Now, one other thing I'd like to focus on here is China. So much is going on in China that, again, the headlines are getting some of this. But within 1 week, a Bloomberg journalist, Sofia Horta Acosta, reported that all of this happened in Greater China this week. I'm going to just read you a few of these to give you a sense of the drama here. Evergrande suspends trading on the stock exchange. And the developer, Evergrande, was ordered, think about this, to demolish 39 illegal buildings because they didn't have the right permits. Can you imagine if that happened in the United States?
It is not only the policies of Evergrande which have put it in this fix, but also Chinese President Xi Jinping's policies. President Xi has been gradually trying to diversify the Chinese economy so that it does not overly rely on real estate through curbing housing speculation. His message is clear. Houses should be for inhabiting, not for trading. Though this approach seeks to help balance the economy, it has shifted more pressure on the existing weak real estate sector. However, Evergrande is one of the many developers that have found themselves in financial fuss, despite being one of the largest developers in China. Many Chinese real estate companies have been facing financial issues, and most have failed to meet their required obligations. Other big developers include Shimao, which recently missed an interest payment of $101 million, and Oceanwide Holdings, which defaulted on a loan of $175 million. This report was able to prove that there are more than 600 firms forming the construction industry that have skipped at least 3 commercial payments in the 2021 and 2023 only, which indicates a struggle, and it is the same in 2024, as major construction companies such as SRE and China City Construction missed their interest payments. The situation is developing month by month and becomes worse with each month. The reality is now clear. The wheel is coming off on Chinese real estate, and it may no longer be a safe investment. Who knew developers are feeling the heat? Sales of the 100 largest real estate companies were down by 16.7% from a year ago, which was the first time this indicator had decreased in more than 20 years. This decline may be described as an abrupt reversal for an industry that in the past 2 decades recorded a steady increase.
The 100 largest developers in China reported that their contracted sales were down 35% in December, and for the year as a whole, they fell for the first time, Sophia says, in at least 5 years. I don't think I've ever seen them fall in the last 20 years. So real change. A few of the other developers went bust. Shimao, which was rated investment grade in November, defaulted on a trust product and rocked the credit market. And the central bank withdrew liquidity. A lot of people thought they were going to increase liquidity because they said they would. A China regulator vowed stability after stock market's rocky start, but they haven't done anything about it yet. And very interestingly, the yuan, the RMB, the local currency, after a very strong year, held up. And I think it held up probably helped by the government, supported by the government. It is starting to weaken, quite a telltale sign. And one stock, Hurong, which had not traded since last March.
Fed's concern. Not even the Federal Reserve has been indifferent to the Chinese housing bubble that is lurking around the corner, with predictions that the downturn in China's housing market may have negative impacts on the entire world economy, including the United States. The Fed has sounded a warning that stress in China's real estate sector could put pressure on the Chinese financial system and maybe even spread to the United States. These concerns are not unfounded, as China's mounting government and local debt have become serious red flags. Everybody tends to think that the high growth rate of China's GDP means its economy is very stable. However, the ugly reality is that China is in the middle of the credit bubble, not only concerning real estate, but touching all sectors of the economy. Loans in Chinese households relative to the available income and the GDP have significantly increased over the past 2 decades. Instead of prosperity, debt has been the driving force behind much of this growth. While China's GDP continues to climb at an impressive rate, its debt is growing at an even more alarming pace. The debt crisis in China has reached such an extent that the country's total debt as a percentage of its GDP is nearing levels typically seen in developed nations. It is concerning to imagine an economic giant like China having a debt-to-GDP ratio similar to that of advanced economies. This kind of financial overstretch is bound to lead to serious consequences. The Fed has also pointed out that real estate valuations in China are becoming increasingly overblown, and the Chinese Communist Party's CCP recent crackdowns could lead to a collapse in these inflated values. These warnings reference the government's 3 red lines policy, which was introduced to curb excessive borrowing in the real estate sector. The 3 red lines set strict limits on how much debt property developers can accumulate. The thresholds require developers to maintain a liability-to-asset ratio below 70%, a net debt-to-equity ratio under 100%, and a cash-to-short-term debt ratio of at least 1. Developers who meet these conditions are allowed to increase their debt by 5% annually for each red line they comply with. Although the policy is targeted at achieving financial stability, it seems the timing may be misplaced. She has been scathing of the CCP as one who has played with fire in claiming to address the problem. According to her, considering how over-leveraged many of the developers already are, these new measures may just wipe out the property sector. It is a colossally difficult task trying to bring them back under control after so many years of unfettered expansion. Indeed, 2 out of 3 of the top 30 Chinese developers have crossed the red lines on at least one occasion. The headache here, as is often the case with such regulations, is that property developers are usually not able to automatically cut down on their liabilities. They have no choice but to commence a fire sale of the properties, which is exactly what several people are attempting to do at the moment. For instance, Evergrande and Kaiser Group Holdings are both desperate to divest certain non-core assets due to the new regulations set forth. Evergrande is trying to offload its headquarters home ground, Evergrande Tower, but still is unable to find a prospective buyer. Kaiser, similarly, has also put 18 of its real estate assets that cover 4.7 million square feet on sale, but no such sales have occurred. The issue is quite distinct. So many developers are wanting to sell properties now that there are too few buyers proportionately to all. They are selling off assets in order to satisfy the 3 red lines, but the market is saturated with inventory. Thus, the only option that is open to these developers now is to lower their price tariffs. Key players like Evergrande recently resorted to coming up with a plan to sell as many of its homes as possible at a 30% discount. But this major cut has not been effective to bring buyers as required by the company to address the ballooning debts. Time is running out, and if property sales remain stagnant as they are now, it would slow down China's once-roaring GDP growth rate. It was revealed in July 2024 that real estate development in China contributes to 20% of the country's gross domestic product. If this sector falls, it will be a very big loss to the earnings of this nation in terms of GDP. The Federal Reserve has also pointed out that this impending slowdown is not confined to China only. Its global effects could grow even bigger to affect economies and markets of other countries across the world. The Federal Reserve has issued a stark warning about China's economic slowdown, stating that it could strain global financial markets through the deterioration of risk sentiment, pose risks to global economic growth, and affect the United States. In simpler terms, if China's real estate market were to collapse, the impact would ripple across the globe, causing widespread economic hardship. Given China's pivotal role as a global manufacturing hub, producing nearly every conceivable good, this is a cause for concern. In 2019 alone, China accounted for over 28% of global manufacturing output, underscoring the extent to which the world depends on its economy. Many might assume that China is simply too large to fail, but history shows that even major economies can falter. The collapse in Japan's real estate market 1989 offers a good reference to what is currently happening in China. The emerging economy that was highly admired in the 1980s, with some research indicating that it could soon become a more dominant economy than that of the United States. The information from the period suggested that in theory, the value of Japanese land was 4 times more than the total value of all the US land. It became an astonishment to the world as Japan successively achieved an outstanding economic record, though their real GDP has been growing at an average annual rate of 3.89% during the 1980s. Still, Japan found itself in a vast debt problem despite such a rising economy and increasing GDP. To say nothing of what is taking place at the present moment in China, Japanese corporations have indulged themselves in heavy borrowings on the basis of directives set by the Ministry of Finance. The ministry had encouraged companies to borrow through low interest rates, coupling it with deregulation, besides domestic measures that sought to boost supply of money by 8 to 10%. These actions provoked a high speed of growth in the economy. Pressing on the prices and raising GDP, the boom was temporary. In a span of 24 years, Japan's stock market had reached a low in 1992 by diminishing to almost 60%, with the Nikkei index of 15,900. In the next 2 decades, the Nikkei eroded by a further 45%, and years were required for the Japanese economy to bounce back, with the equity prices continuing to lag behind for decades. Cathie Wood has drawn parallels between Japan's crisis and China's current real estate market, warning of similar risks. China's property prices have soared to unprecedented levels, driven largely by an escalating debt problem. This situation, according to Wood, could have profoundly deflationary effects on the global economy. Specifically, the anticipated crash in China's economy could send commodity prices plummeting to unforeseen lows.
When China catches a cold, commodities usually catch pneumonia. And we're seeing this in a few commodities, iron ore prices and so forth, but it isn't quite clear-cut yet. And I was saying to our team this morning, how could this be happening and the economy not be falling apart and the consumer not getting restless there? Well, the consumer savings is 75% in real estate. But what I learned this morning, and it does make sense, one of our analysts, our newest genomics analyst, Pierce, worked in his lab as he was getting his PhD at Texas A&M with other Chinese students. In fact, he only worked with Chinese students. And he learned that a greeting in China, the equivalent of a hello, is basically, I hope you have enough to eat.
While the impending collapse has yet to fully impact commodity markets, Cathie Wood has expressed confusion as to why commodities have not already crashed given the circumstances. Typically, weakening consumer confidence leads to lower commodity prices, but confidence remains surprisingly high. This could be a false signal, potentially skewed by rising food prices.
Pork prices and rice prices are critically important. And what do we see happening there? Pork prices are down, depending on the measure, 33 to 50%. Rice prices are fairly flat. And apparently that keeps the consumer happy. Now, I don't know. I think this property debacle is quite something, so we shall see.
An economic crash in China could have far-reaching consequences for global markets, commodities, and trade. Given China's dominant position in the global economy, any significant downturn in its real estate sector will undoubtedly have widespread implications. Property prices in China have already begun to decline significantly. In November, Chinese property sales dropped by more than 16% compared to the previous year, and new home prices saw a 0.3% decline on a month-to-month basis. While a 0.3% dip might not seem substantial at first glance, when calculated on an annual basis, it equates to a 3.6% decrease. These falling housing prices are now slowing at a rate not seen since the economic downturn in 2015. Cathie Wood, in ARKK Invest quarterly report, predicted that China's economy could experience a significant slowdown within the next 3 to 6 months. Wood stated, "If we are correct, during the next 3 to 6 months, the market is likely to focus more on the risk of recession in the US, the serious slowdown in the Chinese and emerging market economies, and potentially a surprising drop in inflation." Several commodity prices are already signaling distress. Iron prices have fallen by 35%, likely in reaction to China's real estate crisis. The Baltic Dry Freight Index has dropped over 40%, DRAM prices are down by 25%, and US lumber prices have decreased by 33%. Even the price of WTI crude oil, which had been a notable exception until recently, has declined by 12%. But realizing this, the Chinese Communist Party has made certain attempts that help avoid further deterioration of the economy. In China's central bank, it has recently announced a cut on the interest rate in the aim of reviving the country's productivity, while in the US, the Federal Reserve Chairperson, Jerome Powell, has affirmed his plans to increase the interest rates shortly. Moody's, as a credit analyzer, estimates that about 70–80% of Chinese households' wealth is in property. This means that if the property market in China were to fail, it reduces the value of this asset by up to 80% of China's wealth and could lead to an economic downturn. The implication for such a collapse is not just for China, but for many countries, since they rely on Chinese production and various products. In other words, a crisis in the Chinese real estate industry would reduce the production rate across the globe, hence causing more harm. As expected, a lot of China's firms are already in violation of their debt payment schedule, where the real worry lies in what might happen if indeed this sort of debt continues building in the months ahead. The fear of a number of other non-payment cases remains on the horizon and contributes another element of the uncertainty of the Chinese economy's future. To this, the Chinese Communist Party, CCP, has started mounting pressure to curb the sector through the ban of what it considers as unlawful property transactions. To achieve this goal, the CCP has brought measures to put stringent rules in the property developers' laws that make these companies to have consideration for societal welfare. Although the purpose of these regulations may sound noble, Cathie Wood seems against this policy. Such mechanisms could end up disrupting the very core of China's real estate amidst the real estate-led economy. Wood has pointed out that China's property market has played a crucial role in driving the nation's economic growth over the years. It has been a key part of the country's infrastructure development and has been central to consumer savings, with around 75% of household savings tied up in real estate. However, China's housing market is now showing signs of strain, with property prices falling to low levels. This downturn is unsettling, not just for the economy, but also for Chinese citizens who have significant portions of their wealth tied up in property. Experts are grappling with a wide range of economic challenges. The Chinese economy now presents a stark contrast, where some individuals can afford luxurious homes while others struggle to secure basic shelter. Despite these obvious differences, Chinese leadership has historically tolerated these issues. This tolerance, however, is now driving real estate prices downward, eroding the wealth of those who once had financial security. China seems willing to take this risk, even as it grapples with the far-reaching consequences of a potential property market collapse. China's property market is undoubtedly facing severe difficulties, and the situation may deteriorate further in the years ahead. In July 2024, S&P has forecasted a 15% drop in nationwide residential property sales for this year, driven by tighter credit conditions and the government's restrictive policies aimed at controlling the real estate sector. As China's economic troubles continue, the global ramifications may only become more pronounced. With that, we have reached the end of today's video. If you have come this far with us, be sure to check out other videos on the channel.